Are you interested in saving for college, but you just don't know what account type is best for you and your situation? Well, please stay tuned and I'll get you an answer that you can use. So today, college costs continue to rise at higher rates than inflation. And it is even more important that you make the right decision on what account to use that is best for your situation. And it isn't the same answer for everybody. In this video, I will explain the different account types, each account type's pros and cons, and how that might be best for different situations. So why does this planning matter? Again, those college costs are soaring, not only on the tuition side, but also on the room and board side, is they are continuing to escalate even faster than inflation. And still today, they are slowing down a little bit compared to where they were in the 80s, but they are still continuing to outpace inflation. So it really is critical that we are taking advantage of different opportunities that are presented to us in order to save for some of those costs. The other thing is the wrong account type could also impact your FAFSA in order to qualify for financial aid. The other thing is a smart structure could lead to lower taxes or greater flexibility. I've narrowed it down in this video to 4 different options. The first one being a parent's taxable account. So it's just a normal account that you have that you would earmark for college costs for your children. It's in your name and it's taxed to you. The other one is an UTMA or an UGMA account. Most are going to the UTMA accounts. And these account types, they are in your child's name, but you are the custodian. So once that child reaches either 18 or 21, depending on your state, that account reverts to theirs. So they can use it for whatever they want. So they may choose not to use it for college. So that is something to keep in mind, is you lose control over that at the age of what they call termination, which would either be 18 or 21, depending on your state. The other option is a 529 account. Those 529 accounts are very popular and offer a lot of tax savings. The other option is fleeting, and it's the education savings account. It's similar to the 529, but it has very low contribution limits, but it does expand on your options as to what you can invest in. However, a lot of companies out there aren't allowing you to create a new education savings account. So today I'm going to focus on the first 3. So the first one is that taxable brokerage account in the parent's name. So what are the pros? So the pros are obviously you can use that money for whatever you want, whenever you want, and there's no stipulations to it. There's no penalties for non-educational use. You can use it for your own vacation and leave the kids at home. There's also lower capital gains rates than ordinary income. So when those funds come out of the savings account, they're going to be taxed at long-term capital gains rates as long as they were in that account for longer than 1 year. The cons are there's no tax deferral and there's no additional tax savings on these type of accounts. It also counts as a parent asset for FAFSA, so 5.6% of that portfolio is going to be used as a parent contribution when they are calculating financial aid. Second is an UTMA or an UGMA account. So the pros here is they can be used for any child-related need. So if the child decides not to go off to college, but wants to start his own business, or wants to start into a trade, or wants to go straight to work, or wants to go into the military, they still have access to those funds and they can use them for whatever they want. It doesn't have to be an educational expense. The other benefit is some of that money is going to be appreciating at the child's rates. So when they pull it out, some of that money will go against the child's taxes, not yours. The cons is the FAFSA counts these accounts as 20% because they are a student asset. So it is a great impact to the FAFSA if the funds are stored in an UTMA or an UGMA. It's also irrevocable. Once those funds go in, you can't pull them out for your own purposes. It is illegal. Now, they would sue you for that, but it technically is illegal for you to pull those funds out for anything other than a benefit to the child. The other thing is, again, that kiddie tax will eventually apply. So if you sell something and let's say it has $3,000 of capital gains, well, the first $1,300 is going to be tax-free. The next $1,300 is going to be taxed at the child's rate, which most likely is going to be that 0%. But then the rest is going to be taxed at the parent's rate. So you'll get that first $2,600 for most likely for free, but that last $400 is going to be charged at your capital gains rates. All right, the next one is the most popular, and it does have the most advantages. It's that 529 college savings plan. These are within an individual state, and they're sponsored by a state, but you can get them from wherever. You can go to, let's say, a Vanguard and get one from Nevada, or you can go to a Fidelity and get one from a different state. If you have a tax deduction for your state, then you want to be very mindful to use something that is in that state. So it may not be a good option for you to choose one of those bigger companies because they offer a 529 in an outside state. So if you do have a tax deduction in your individual state, try to look for one that is in your state so that you will get that state tax deduction. These funds in this account will grow tax-free, and they'll be tax-free on the way out. So they're taxed at the beginning, kind of just like a Roth IRA or a non-deductible contribution to a traditional. They're going to be taxed at the beginning, but they're going to grow tax-free, and it's going to be tax-free for an educational purpose on the way out. And it also has a high contribution limits. Now, the cons are if you pull these out for a non-qualified purpose, you're going to have to pay a 10% penalty, plus you're going to have to pay the income tax on those earnings. You've already paid the tax on your contribution, but those earnings, they will be taxable. And they're going to be taxed at your income rate, not a capital gains rate. There's also a limited investment menu. So when you apply for a 529 account, you're going to be given a list of funds that you're allowed to contribute to. So it does restrict what you're eligible to contribute to. But a lot of times they have very diverse offerings there, and usually this isn't a factor. If the parent owns the 529, those will count as a parent asset and resource for FAFSA and will be at a 5.6% rate. 5.6% of any 529 account will be considered a parent contribution. However, if that 529 is owned by, let's say, your grandparent, it doesn't count. So that is something to consider. Now, what is a 529 qualified expense? So 529 qualified expenses include tuition, fees, books, supplies, equipment. It also includes room and board if they are half-time or more in attendance. It also counts for computers and internet access. And in new developments, it can even pay up to $10,000 per year for K through 12 in secondary education. It can also now pay for $10,000 of student loans. So keep that in mind. If you've got a siblings account, you can transfer that siblings account, change the beneficiary to a different sibling, and use that $10,000 to pay off their student loans. But it's $10,000 per student. You can also use it for approved apprenticeship programs. Here is another great opportunity. It's the 529 to Roth conversion. So this was just created in the Secure 2.0 Act, so it is fairly new. First of all, there's going to be some very strict rules associated with this. So the first one and the most restrictive is the account has to be opened for 15 years. When you first have your child, it's a good opportunity to open a 529 right away just to get this clock running, because it is a 15-year clock. And if you want to use it when they turn 18, then you need to get that money in there relatively quickly in order to be able to do this. The other thing to keep in mind is if you had one account and you decided to split it into a second sibling, be careful of this because this creates a new account. Even though it was split, if you split it and it has the same beneficiary, you're fine. The IRS still views that as having been created 15 years ago. But as soon as you change that beneficiary, then it restarts the clock again for those 15 years. So make sure that you're starting one of these for each individual child as young as possible. The other thing is the funds that you want to take out need to have been in the account for at least 5 years. So this is something to consider. Those funds have to have sat in there for at least 5 years. Now, you can still pull funds from earlier as long as you're not pulling those funds from the last 5 years. The other thing is it's still subject to all the Roth IRA limits. So you can't put in any more than $7,000 a year for 2025, and it may change in future years, but keep that in mind. You have the ability to do all the way to $35,000, but you're going to have to do it in chunks based on the Roth contribution limits. The other thing is they do have to have earned income equivalent to the amount that you're converting. So if they only earn $6,000 in a year, you can't convert $7,000. You can only convert $6,000. But the end result is you're able to turn these college savings into a nest egg for a future retirement for your beneficiary. Here's another key player that you need to keep in mind, especially when using those 529 accounts, and that's how it interacts with the American Opportunity Tax Credit. So if you are eligible for this based on income limits, it gives up to $2,500 of tax credit for tuition for the first 4 years of college. There are some other stipulations that you might want to look into, but it is eligible for the first 4 years, and it's $2,000 of the first $2,000, and then it's 25% of the next $2,000. So if you spend $4,000, you will receive $2,500 in tax credits for that year. So you want to make sure that you take advantage of this opportunity because that's $2,500 of free money. But you can't use 529 funds because the government sees that as double dipping because you took advantage of a 529 tax advantage plan and now you're taking advantage of the American Opportunity Tax Credit. So here's a great strategy is make sure that each year you spend $4,000 of out-of-pocket funds in order to pay your tuition part of your bill and then achieve those $2,500 in tax credits. Then the rest of the tuition and the room and board, you pay that out of your 529 and repeat this for the first 4 years of college. Here's how the FAFSA treatment works. So a 529 account, if it's parent owned, it's going to be owned by the parent and it's going to be attributable at a 5.6% contribution rate. So you do kind of need to plan around this. It is going to count against you, but it isn't going to count against you as much as say an UTMA or an UGMA account. Now, if that 529, and again, this is a recent law change. So if you're listening to this and disagree with this, go ahead and check it out. It is a very recent law change. But a 529 owned by a grandparent or a third party is not considered an owner for FAFSA, and the assessment rate of any funds that are pulled out towards paying for college for that beneficiary don't count as any part of your contribution. It used to be where they counted, but FAFSA is always 2 years in the rear. So you want to make sure the grandparents were paying in the last 2 years. But now it doesn't matter. So you can use those grandparent 529 funds even in the first and second year. Now, the UTMA and UGMA accounts, they're going to be student owned for FAFSA reasons. And now those are going to be credited as 20%. So the student contribution rate is 20%. So any funds in there will count almost 4 times as much as a 529 account. And a taxable account, it's going to be considered owned by the parent and backs that 5.6%. Again, that is most flexible, but it is going to count against you at the 5.6% rate, which again is still better than the UTMA or UGMA. So these are the key takeaways for education savings. So the first one is the 529. It is going to be the best for long-term tax efficiency. Being able to let it grow tax-free and then take it out tax-free, that benefit is only going to be available for a 529 account. Now your UTMA and your UGMAs, those are going to be flexible, but there is going to be some tax on those, slightly lower rate for that first $2,600. And there's also going to be some very large FAFSA impact. So if that's going to be a player, you may want to consider something other than an UTMA or an UGMA. A taxable account, by far the most flexible. The flexibility is the most important thing to you. Then maybe the taxable account is the best opportunity for you. And it does have that lower contribution for FAFSA. It's only at 5.6%. It's also a good portion that you want to put some money in those taxable accounts to use for that $4,000 for that American Opportunity Tax Credit. So maybe you want to keep some of that growing in a taxable account and the majority in the 529 account. So they kind of go hand in hand. These are the actions you need to take today for your education savings account, for your children, and maybe even some other family members. So decide what the best option is for your current situation. Is flexibility the paramount part of your decision? Or is saving the most amount of money and gaining the best tax advantage the most important? And how does the FAFSA play into your decision? Those are all things that you need to consider, but go ahead and decide which account it is, and then get a good online calculator to figure out how much you need to be saving in order to reach those goals, and then open the account and start funding it today. Don't wait till tomorrow, start it today. And if you need help with making some of those calculations or taking those first steps, please reach out to me, give me an email, and I'll be glad to help with a full financial plan. I hope you've enjoyed this video. If you did, please like it and please subscribe so you can see other videos. And if you've got any comments, please throw them in the comments below. And if you've got a suggestion on a future video, I'd love to hear what you'd like to hear.
Information provided in this video is for educational and informational purposes only and does not constitute financial, investment, tax, or legal advice. I am not your financial advisor, and you should consult with a qualified professional before making any financial decisions. All investments involve risks, including the potential loss of principal. Past performance is not indicative of future results. This video does not endorse any specific investment or strategy. By watching this video, you agree that I am not responsible for any financial outcomes based on the information provided.